All right, let's jump right in. Today, we're digging into a pretty provocative idea: the possibility that the software boom isn't just cooling off, but is actually heading for a structural decline. We're going to break down the forces behind this potential shift, and we'll use a key market leader as our playbook. So here's the big question on the table. Is tech's golden age over? And look, we're not just talking about another cyclical dip here. We're asking if the very foundation of the software industry is changing in a way that could permanently push valuations down. To get straight to the point, our analysis suggests a plausible long-term price target for a giant like Palo Alto Networks could be somewhere around $102. Now, this isn't just a number we pulled out of thin air. It's based on a deep cycle correction model, and yeah, it signals a massive drop from its recent highs. We're about to show you exactly how we get there. And this isn't just a story about one company. Not at all. The same model suggests that the entire IGV software ETF could get pulled down towards the $60 mark. The risk here isn't isolated. It's a sector-wide thesis, and it has some huge implications for any tech investor. So how in the world do we get to these kinds of targets? Well, this isn't about feelings or market sentiment. It's about a collision of four really powerful forces that are creating what looks like a perfect storm for the software industry. Let's break down the core of this bear case. The whole argument really rests on these four pillars. First, you've got AI driving consolidation, which means fewer, bigger winners. Second, that consolidation is causing margin compression across the entire sector. Third, we're seeing a classic capital cycle reversal after years and years of overinvestment. And finally, tightening financial conditions are the macro trigger that could set it all off. Any one of these is a headwind, right? But put them all together and they could be truly transformative. To see this playing out in real time, we have to look at Palo Alto Networks. They are literally writing the playbook for how a market leader can aggressively consolidate power, and it's starting a domino effect across the whole industry. PanW's strategy, especially through 2026, is the absolute key here. What they're doing is intentionally sacrificing short-term revenue. Why? To bundle their services and lock customers into their platform. The goal is pretty clear: absorb or just plain starve out the smaller rivals. And the direct consequence of that is margin compression for pretty much everyone else. And this isn't a new story. We have seen this exact consolidation playbook before. Just think back to the telecom sector in the late 90s, or the ERP software space in the 2000s, when it was all about SAP and Oracle. Or even more recently, the cloud infrastructure wars that saw AWS, Azure, and Google squeeze out almost everyone else. In every single case, the outcome was exactly the same: a collapse in valuations for the rest of the sector. So all this strategic pressure, it has a very direct financial consequence. It creates this kind of compression vice on margins. And that's the mechanism that could lead to a dramatic re-rating of what investors are willing to pay for software companies. And right here, you can see the potential damage. In a bull market, it's totally normal to see software companies trading at 8, 10, even 12 times sales. But in a structural decline like what we saw after 2000 and again after 2008, those multiples can get crushed down to just 3 to 5 times sales. That isn't just an adjustment, it's a collapse. And here's the great paradox in all this. The very technology that's driving so much hype, AI, is also a really powerful deflationary force. Think about it. As AI makes it cheaper and faster to write code, to maintain it, to integrate it, the intrinsic value and the defensibility of a lot of software products goes down. Software basically becomes cheaper to make, which ultimately has to compress valuations. Okay, so we have all these sector-specific pressures building up, but what's the spark that lights the fuse? Well, the macro trigger to watch is the Chicago Fed's National Financial Conditions Index, the NFCI. When that thing starts to rise in a sustained way, it signals that liquidity is tightening up. And historically, when liquidity dries up, those high-growth, high-multiple stocks like software are always the first and the hardest to get hit. So now let's take a look at how this could ripple out across the market. The risks we see in the Palo Alto Networks case, they are not isolated. They actually reveal some systemic vulnerabilities across a lot of other high-flying software stocks. Let's run through a few key examples. First up, Palantir. It's trading on a pretty significant hype premium, and it relies heavily on those long, cyclical government contracts. That makes its valuation extremely sensitive to the kind of financial tightening that a rising NFCI would signal. Then you have Shopify. It's tied directly to consumer spending and the health of small businesses. That makes it highly cyclical. And if you look back, SHOP has a history of seeing these huge 50 to 70% drops during periods of financial tightening. CrowdStrike is another one that's sitting directly in the crosshairs of this whole platform consolidation trend. Its high valuation is really vulnerable as giants like Palo Alto Networks and Microsoft keep bundling competing services, squeezing out these specialized single-purpose products. And finally, companies like Okta and Snowflake, they face a different but related threat: commoditization. Their core products, identity management, data warehousing, they're becoming increasingly standard features inside much larger platforms. And that's a huge threat to their growth and their pricing power. So to be perfectly clear, this isn't just a single-factor argument. It's the confluence, the coming together of these four forces all at once. You've got strategic platform consolidation, AI-driven commoditization, historical valuation compression, and that macro trigger of tightening financial conditions. All the evidence seems to suggest we could be at the end of a major tech cycle, one that was defined by growth at any cost and this massive proliferation of venture-backed point solutions. And that leaves us with a really crucial final question to think about. If this cycle really is ending, what are the fundamental characteristics that are going to define the next one?